All right, so now we have a scene for the landscape of DeFi and future of payments. It's time to put our investor hat on and have a little look at the opportunities that are out there and how we can really maximize them in this bearish market. This is the time to kind of dive deep into new projects and really emphasize adding to your portfolio and expanding in that regard. So we have a great panel discussion now, investing in the bear market. I'm going to welcome our speakers to the stage. We have Josef from Draper Goren Holm, Todd Goergen from Rapper Asset Management Funds, Elana Dickman from Redbeard Ventures. We have Jeremy Gardner from Awesome Ventures, Miko Matsumura from Gumi Cryptos Capital, and Lou Werner from blockchain and Coinvestors. So let's have a big round of applause for our speakers. Thank you.
How's everybody doing this morning?
Good morning, everybody. Day 2. How are you feeling? We just had a really interesting conversation this morning before the panel about the quality of the attendees and the startups, and I think that's also the sort of overarching topic of this panel, investing in the bear market. But before we get started, I think it's easy for everyone to see Jeremy is not here. He spoke yesterday, so this is not correct up there. Apologies for that. But other than that, we have a fantastic panel, and maybe we just start over there with Lou. Give everyone an introduction, who you are, who you work with, what kind of startups you're investing in, what you're looking for, and then we'll just dive deeper. And also, I would like to make this very interactive. Jessica has a microphone over there. So I encourage all of you to ask these people questions, right? Like that's really what I'm trying to do, is bring them up here, make them sit still for 45 minutes so you guys can ask questions and get the insights that are otherwise hard to get. So let's get started.
Okay, sure. Hey, I'm Lou Kerner. I'm here for Community and the Revolution. I work with a company called Blockchain Co-Investors, and we are a crypto fund of funds. So we invest in more than 40 of the leading crypto VCs around the world. We do one-off investments largely that we get from the VCs, and we also have a crypto SPAC.
Great. My name is Miko. I'm with the fund Gumi Cryptos Capital. We are now in our fund 2, so we invested our fund 1 about 21 million into the crypto winter of 2018-2019. I think about 8 unicorns out of there. We led the strategic seed round into OpenSea. We were in the seed round of YGG, or Yield Guild Games. Let's see, early into 1inch, Credo, Agoric, a Star, about 8 unicorns so far out of that. We raised recently $100 million fund 2, so I'm deploying that into this crypto winter. So, you know, really, yeah, I think, you know, we're very high conviction, especially on this whole sector.
Hi, everybody. My name's Elana Dickman. I work at Redbeard Ventures, which is a Web3 VC. We started with the syndicate about 2 years ago, made over 100 investments to date. 70% has been Web3, the other 30% frontier tech, but we invested in Sandbox, Dapper Labs, Wilder World, Super Rare, Zedrun, and 100 others. And then we're raising our fund right now. So already started allocating money out of that, and that's specific to Web3 and crypto pre-seed to Series A. But excited to chat with you all today.
Hello, my name is Todd. Ropart Asset Management is a very broad mandate fund where we invest in a lot of tech, from things like Gemini to things like Maverick to things like Onera. I invest with this guy a lot, and respect the DJH guys quite a bit. We have a very open mandate, everything from startups to mature businesses. Really, I think of blockchain as SaaS. So I've probably been a little bit older than most of the people here. So we've been investing in SaaS tech for at least 20 years. So very broad mandate and a wide range of investment. We're not raising money.
Cool. For those of you who don't know me, my name is Josef Holm. I'm founding partner of Draper Goren Holm. We're a California-based venture studio and fund. I've been living in Dubai for over a year now, and I'm leading our expansion in that area. And we're launching our new fund very soon and have a few very exciting initiatives in the pipeline that will give us and the whole Draper network and Draper University and Startup House a bigger footprint in Dubai, and help startups come to the city and meet the right people, build a network, and launch a successful startup. So anyway, obviously everybody has a different strategy when it comes to investing in a bear market, right? But what from if I want to pitch you guys today, how should my pitch be different than it would have been like maybe 12 months ago, or whenever Bitcoin was at $60,000 compared to today, and what are the biggest mistakes that that entrepreneurs are making in the bear market?
I think it's a builder's market. So I think, really, I think it isn't a land grab. So, I think when we look at early stage teams, in a way our ideal team is maybe one engineer, one product person, right? So, really like lean startup. So, we want frugality. We think that really, we think hyper lean is great, long runway, very cash efficient, so these are the types of things we like to see. We think that a lot of hangers on, maybe like, getting too early into kind of marketing hires, this kind of stuff, like it's not optimal. So that's the way we see this type of market. I mean, we're super early stage people, so that's what we like to see.
It's really funny, you see a lot of that in Dubai during a bull market, man. Everybody is like, I don't know, they have a Lamborghini with the company logo, and they have a 2,000 square foot office at Burj Khalifa, and then they invite you in as an investor and you're supposed to give them money. I'm just sitting there and I'm like, yeah, no.
And then they leave them at the airport on their way out of town.
Exactly.
Well, actually, I mean, I just got back from Token 2049 in Singapore, and I got to tell you, there wasn't a bear market there.
Crazy.
The regulations are different, and they're just much bigger speculators. And for me, I'm not doing anything different. People come up to me and go, God, I love bear markets, and I'm thinking, God, wait until the bull market. You think this is fun. But as an entrepreneur, you just got to build, right? I think what Benedetto said on the last panel is true. We're not going to teach our way to mainstream. We're going to get to mainstream when somebody builds something that other people want to use and can use at scale.
Right. I agree. When it's no longer a blockchain product, but a product that uses blockchain that's better than the previous one.
Exactly.
I agree.
And I'd also say 2 years ago, anybody could go ahead and raise money. It was pretty easy. Everybody was coming to us. They were trying to raise, and people still are now, but we see a little bit more traction on that side, a little bit more being built as opposed to just a PowerPoint deck of trying to raise money. And then also from a VC perspective, we've been able to push back a lot on valuations, which in turn is beneficial for us all. Like, you don't want to be raising at too high of a valuation, then having a down round a couple months later. So that's been, I think, really beneficial as well, and just a difference that we see in the market today.
I mean, I agree with Lou. I mean, I don't think our approach to investing has changed at all. And I think that for old people like, some of us in the room, when you're looking at any venture opportunity, you're always looking for a path of profitability to self-sustainment. And I think a lot of people completely missed that over the last 5 years, and they just wanted growth at any cost. So the way we do it at Ropart, we've never looked at investing like that. So we've always invested in businesses, whether it's a startup, whether it's Series A, whether it's Series B, C, D, whatever, or even mezz loans. We always look at it, okay, so where does the company get to, where's the tipping point to profitability, cash flow positive, self-sustainability? Because you don't know when crypto winter is going to happen again. Because as most of us in the room have seen crypto winters several times. It's not once, it is seasonal, just like winter.
Yeah. Now let's talk about valuations a little bit, because I think you make a very important point. They change in bear markets, and you don't want to end up raising a down round. Can you talk about that a little more and explain to fundraising entrepreneurs what that really means and what the consequences are and how to maybe avoid it?
Yeah, for sure. I mean, I'd say first off, I think we're still seeing crazy valuations, specifically in Web3. I think a lot of businesses outside of Web3 have definitely been more in line with what's usually a pre-seed or seed. But in Web3, they're still pretty high for what the companies have built. So I think in turn, when they're raising at such a high valuation, and then they're telling us, okay, we're gonna have this much revenue at this certain date, we're gonna be doing this many hires, we're gonna have the product ready, and then most of that stuff doesn't happen. They don't hit the revenue, they aren't able to build what they thought they were going to build, and then they go ahead and try to raise again. Well, they're gonna have a lower valuation then, which hurts everybody. I mean, they're giving away more of their share of the company at a lower valuation than what they initially built. A lot of investors aren't interested in investing, and they're running through a lot of their burn and a lot of their cash on hand. So it affects a lot of people.
I mean, I love a down round. I mean, if you statistically, it was actually PitchBook did a nice piece on down rounds about a month ago. Most companies that can actually raise a down round rather than going out of business are successful. So I don't mind down rounds. I don't.
Still have to take a haircut though.
Oh, absolutely. Yeah. But that's the thing. When you come in, when you're a steward of capital, I think like everyone on this panel, and you have cash, you can dictate terms, and you can dictate sometimes onerous terms, but more realistic on current environment. And you give everybody who's a current investor an opportunity to pay to play, and that it works really well because you find out who's committed and who's not.
So there was a tweet the other day, and an entrepreneur brought it to me and said, okay, here's a bunch of like the new normal, right? Here are the new averages for valuations at different stages, right? And it just brought to mind something that my business school operations professor told me, which is, if you believe in averages, go stick your feet in a freezer and stick your head in the oven. Right, that was his advice, right? Because when you think about the power law distribution of venture returns, right, the curve looks like this, right? And so, like, if you're trying to figure out, like, oh, what's the average company going for, like, your head is just wrong. Like, it's like, that's dumb. Like, that's the wrong way of thinking about it. I think Lou's kind of idea of, like, all real estate is local real estate, I think is especially true for startups, right? Which is, a startup ideally, I mean, a startup is the de facto monopoly, right? It's a monopoly on that specific team doing that specific thing, right? There's no one else in the world that's you, right? So, like, in a sense, like, how much more local can you get, right? So, I mean, obviously, like, the pitches we're seeing, like, maybe 80% of those pitches are, like, super familiar pitches, because, it's like, okay, I've seen this pitch 100 times, but, like, it doesn't mean that the team isn't going about it in a new way, right? So to me, like, yes and no, right? Like, on average, valuations are depressing and compressing, but, like, there's still amazingly good teams, and there's amazingly good deals that are even fairly high priced.
Yeah, I agree. Go ahead, please.
Yeah, to a large degree, valuation is supply and demand. And so, yeah, Elana's right to the degree that maximizing your valuation is not always the right thing to do. But, it's hard when somebody's giving you a high valuation, say, hey, you know what, thanks a lot, but I want a lower valuation, right? That's a tough one. And most of the people who do that learned how to do that because something bad happened to them when they did something else. For me, the most important piece of advice that I give startups, about 80% of the time I get a deck, I go to the last page of the deck, or the financial page of the deck, and I go to the out year, and I add a 0. Because we all want to see really big ideas. If you're a VC and you don't get a 10x, it's going to be hard to raise a second fund. And so, you need a 10x. Actually, one of my favorite stories you mentioned, Tim Draper, that Tim, about a VC and what a VC does at the very end of Bad Blood, the movie about Elizabeth Holmes, when, Tim, he wasn't really in the movie, but clips of him telling the world how great Elizabeth was, being her biggest proponent was, and then at the end, it's this massive, massive dumpster fire, like one of the worst dumpster fires in the history of startups, and now they have Tim live in the very last end of the movie. They ask him, what was the mistake you made? And he gets a big smile on his face, and he goes, "Mistake?" He said, "I didn't make a mistake. I'd invest in her again."
Wow, yeah.
I mean, I think
That's
he's
conviction.
he's talking about asymmetry, right? Which is you can only lose all of your money. That's the maximum you can lose, right? But if you can have, like YGG, it's like, oh, 500x return, that's good, right? So like, you can gain more than you can lose, right? And obviously diversification plays a role here, right?
Oh yeah, totally. And if someone, we all invest in people, right? At this very early stage, it's mostly teams that we invest in. And if they fail, we hope for them to fail fast so we can invest in their new thing and, start something else. But it's not necessarily just the project that matters at all.
Did you see, Idealab, the founder of Idealab, Bill Gross, the first internet incubator, and he did a TED Talk in 2015 where he did a data-driven analysis of the more than 250 startups in the history of Idealab, 8 unicorns, arguably the greatest business idea in the history of mankind, paid search, came out of Idealab. And he said in his talk that, when I started it in 1994, I thought it was all about the idea, which is why I call it Idealab. And then after a few years, I realized, oh my gosh, it's all about the people running the company. And then he ran the numbers. Turns out dominant factor driving success of startups, timing.
You guys are so much nicer than me. It's unbelievable.
I mean,
I like to invest in entrepreneurs when they're successful and they exit and then we do it again. I don't like to invest in entrepreneurs who fail and then we fail again. I'm going to try to avoid that one.
Can I write that down?
Yeah, but Woo, you're more successful than me.
I mean, I think Mark Andreessen said all entrepreneur pitches are true, subject to business timing. So, I think that's a fair assessment.
Yeah, but only those bear market entrepreneurs, those are the cockroaches that really have what it takes to survive a nuclear winter and come out on top as the winners. I mean, at the height of the last bull market, it was just I mean, it was comical, the kind of shit that we saw. And in particular, Dubai just attracts those kinds of people, right? You have like 10x of those hustlers and scammers there. I have blockchain, I have token. I'm like, okay, what's your business model? Token sale. And I'm like, dude, token sale is not a
Dude, it's buzzword bingo.
But what are the differences like between those fair weather entrepreneurs and the cockroaches that really survive something like this?
I mean, my mindset is this, right? Which is that they kind of have to be mutant cockroaches, right? In the sense that like they got to be able to make the turn, right? Like I feel like cockroach only, it sort of like isn't enough, right? They have to kind of have both, right? Because if the turn happens, they have to turn, right? Like if the turn happens and they're still kind of hiding under a rock, that doesn't work, right? So it's really someone who's firmly ensconced in reality, let's put it that way, right? Because if the reality is go, they should go, right? But it's really reality that, one of the great things about winter is that it's so cold that your like face hurts, right? Like Joseph, I know you grew up in Austria, right? I grew up in like Wisconsin, right? So it's sort of like, that's pretty real. You know what I mean? Like, the senses like get very sharp, and if you're really kind of like pretending that it's not, like you'll just freeze, right? So like.
Well, also what I don't get is VCs who say, hey, winter's coming, batten down the hatches and, it's a little late then, right?
I
winter
agree.
is always coming. Aren't you aware that winter is always coming? What?
Yeah, right? Why do you have to change your strategy?
Exactly.
Just because winter's coming.
Exactly. Your job, you have one job as an entrepreneur, to survive. That is your job.
That's where I disagree with both of you guys, because when you're in an environment where you cannot go out and raise the next round, you do need to actually be a little bit more careful with your spending, your capital, as a steward of capital, once again.
But my point is winter is always coming. So
okay, so then always don't have growth at any cost then.
I'm sorry?
Always, so then goes back to my original point.
You always have to be a frugal entrepreneur, right? I mean, that's what you're both saying, I think, yeah.
Yeah, look, everything's a question of balance. Obviously, you got to spend, to make it, right? But but on the other hand, you got to survive, and you got to balance those two. And my sense is the majority of entrepreneurs are out of balance on the spending side.
Well, and I agree within the past, it was so much easier to raise. So if they were running out of money, they just went out and raised more. But I agree that they should be more frugal and they shouldn't be having their burn rate so high. But in the past, it was just so easy. They were like, okay, we're running out. Let's just go raise another round. So
can I toss out something on frugality? Right, which is, so one of the things that we're seeing that is, I think, a hangover from like Web3 mindset is basically like, yes, Web 2 is like horribly broken. It's incredibly stupid, right? Like obviously Web 2 is a disaster. And you know, traditional finance, of course it's a disaster, and of course they betrayed us, and of course it's nonsense, and of course we have to destroy it all, and of course we have to have a revolution, right? That's all true. But the thing that's never happened is that software has always survived and is like the concept of legacy software means that we never have thrown everything away, even if it was trash, right? I mean, so my point is that like maybe it's like Web 2.0.6, right? And maybe all we do is we get the privacy and security model of Web3 on blockchain, and we just put it into kind of like apps, right? And maybe we get, you know, on-chain transactions that are decentralized and distributed, and maybe we put that into apps, right? So I mean, I guess what I'm saying is that the idea that we have to like reinvent everything and that every freaking thing in the world has to be a DAO and everything else has to die a fiery death, like, I'm not buying it, you know, because I think that's a different kind of frugality.
That's
right?
also that maxi mindset, right? That just
like if you look at the history, if you look at the 3.7 billion years of like brain evolution, right? What you have is a lizard brain with a monkey brain built and slapped on top of that, and then you have a human brain slapped on top of that, right? So it's sort of like it's never worked. Like replace everything. Like it's never been replace everything.
I think you're half right. In that, I think there are two things. I think there are two things going on. I think in the real world, you're right. We're not going to replace everything. It's going to be like e-commerce, right? This is going to take an ever larger percentage of the real world for the foreseeable future. Just like e-commerce is still only like 20% of all commerce 25 years later. But there's also a new world coming, the metaverse. And in the metaverse, it's all going to be this, right? It's all going to be replaced by this, and that might actually be bigger than the real world for a long time.
So what I'm not saying is that the evolution of like the neocortex doesn't matter, right? I'm not saying that. Like, I mean, it's made a difference. You know, like we're all talking apes sitting up here. You know, so like that's cool, and I'm glad that happened, right? But what I'm also saying is that all the same old stuff still exists, and the metaverse is going to be built on a lot of the same old stuff.
Right.
But let's define Web 2.0 for a second, though, okay? Because if you're looking at mobile as Web 2.0, which is maybe Web 2.5 or something like that.
I'd say Web 2.5, yeah.
Okay, so that's part of 2. It's Web 2, start part of
maybe 2.6.
Okay, so mobile is not only not trash, it is an incredible business for here forever, right? I mean, the mobile part of technology is a constantly evolving technology, and I mean, you think about your phone, you do everything on your phone. So if that's Web 2, that's not something that I'm going to throw in the trash. I mean, I would definitely still look at technology that's based on mobile, like whether it's mobile advertising, which we had an incredibly successful investment in mobile advertising, like whatever called 40x over 3.5 years. That is not made up number. That is a real number. And so you think about that. As long as you have, once again, mobile 2.7, Joseph, but that's still part of
2.612.
2.612. But it starts with 2. And so, so when you think, okay, so think about search engines is 1.0, and then e-commerce is 2.0, and then mobile is 2.5 plus. Is that how you look at it, Miko?
Yeah, I mean, I think that, the funny thing about Web 2.0, 3.0, and things like that is it's really hard to talk about, right? So in a sense, it's mostly kind of just spitballing, So to me,
it totally is.
But what I'm really saying is that I'm saying that the passion to reinvent is very admirable, but like in order to really provide new value, you kind of not have to completely disrespect things that people have been doing for like hundreds of years, you know, and just say, that's dumb. We're smarter than all of those people and everything they've ever done. Like, we're gonna reinvent governance, and we're gonna do it this really newfangled way that involves me rug pulling everyone, you know. So like, that's not frugal. Like, that's a waste of energy. It's a waste of effort. It's wasteful.
So I'm just curious to know, like, which sectors then do you find exciting about Web3 versus just broad kind of changing everything from Web2 and bringing it into Web3?
Yeah. So one of the portfolio companies that I'm especially pumped about is Lit Protocol, and they're using multi-party computation to create this kind of cloud wallet infrastructure. So for example, an example is token gating, right? So they're, you know, so basically, you know, you can do token gated Zoom, you can do all this token gating, and all they're doing is they're bringing the security model and the privacy model of Web3 into Web2 applications, right? So that kind of methodology is like, what if the Web3 Discord was Discord? What if the Web3 Twitter was Twitter? What if the Web3 Zoom was Zoom? You know, and in a sense, none of those things need to be thrown away. You know, we can just bring the superpowers that we've gained into this, like, new world.
But I would say, like, Zoom, for example, they're not going to be making it more immersive, like Zoom is Zoom. But I see a company coming into Web3 that's a lot more immersive, where we're going to be, like, I spend 8 hours a day on Zoom. And I see the future of a Zoom-like company where it's actually way more immersive. I don't know if you've ever looked at SoWork or one of the other companies where you really sit at a desk. I mean, I got pitched once and it felt like I was there, and it made it more gamified version. But I don't see Zoom doing that. I see a Web3 company.
So let me throw something your way, which is like, if you saw like Zuckerberg and Nadella launching kind of the Cambria Quest Pro headset, right? One of the cool things they had is Microsoft Teams, like, in kind of VR, right? So there's still video, there's still face-to-face, right? And Teams is sitting inside of this more immersive environment. Like, is that the model? It's unclear, but you know, to me, like, it's frugal, right? Because we didn't throw away stuff that worked.
It feels to me personally that I really feel like, you know, I call it that we're in a fucking war for the soul of the metaverse. That's where we're going, and you know, it's all controlled right now by what I call FAMGA: Facebook, Apple, Microsoft, Google, and Amazon. And they've had an ever-increasing share of tech market cap for you know, more than 15 years now. And you know, if the world ends up as you're talking about it, which, you know, I think it's, to me, it actually feels epically like Star Wars, and they're the Death Star and we're the Alliance. And the world's obviously a better place if we win. But if the world's what you described, haven't they won?
No, I disagree. So to me, like, they have to go, but we can kind of use and commoditize their software, right? So, like, you know, they still exist, right? But they exist in a fundamentally weakened form.
I don't know. I'm pretty sure we got to slay them. I mean,
Before we get too carried away, are there any questions from the audience? Now would be a great time. We have about 12 minutes left. Jessica has a mic.
Just because Facebook changed their name to Meta doesn't make them part of the metaverse.
I mean, just a counterpoint, like, you know, I got my start in Java, the programming languages, and, you know, I had a really nice sushi dinner with Guy Kawasaki, the Apple evangelist, and he said, Java will never work because you can't beat Microsoft. That was his take, right? But Java worked. And in fact, the biggest Java desktop app in the world is Minecraft, which is owned by Microsoft, right? Now we have Nadella's Microsoft, right? So in a sense, like, obviously Microsoft is one of the monopolists, and, you know, in this era, they're, you know, a different kind of, like, opponent. But, you know, I think it's possible to tame and make honest people who've historically never been so by just out-competing them, just by delivering better
But are you advocating capitalism or something else?
I mean, this is capitalism.
Okay, so
right, but Betamax is better than VHS, but Betamax is dead. You guys don't even know what that Betamax is.
That's true. That's valid.
We're not that old.
Is there an audience question?
All right, audience question.
Hello. Hi, my name is Noel Borges. I'm curious on your thoughts around investing in companies via token sale versus equity, or is it and equity within this crypto winter versus previous to the winter?
So yeah.
Who wants to start?
Yeah, but what's the utility tokens versus security tokens?
So for us, it's always equity first. And then if there is a token issued launched later, then we get pro rata tokens. but we're very traditional like that, and we think that equity aligns founders and investors on a long-term basis much better. So that's our focus.
I mean, I agree with Joseph. I mean, I think of a lot of times tokens are like warrants. They are the cream on the top of the ice cream. You know, whatever, butterscotch, whatever you want to call it. But I also think that it's important, and maybe one of you guys want to talk about the utility tokens versus security tokens. Very, very big difference. And remember, there are 30,000 plus tokens that exist today. 30,001. Today, too.
So we actually look at both equity and tokens, and lately we've been looking a lot more at token companies. We feel like people who actually nail the utility behind the tokens will be really successful. So that's something that we look at personally, but we're open to both, but that's just something we...
Yeah, historically we've done both, and you know, for us, like, the critical factor for us is alignment. I think Joseph used the word, and I think alignment is key, right? So in a sense, the worst thing that we ever see is when someone's like, well, I'm going to sell tokens out of this pocket to this group, and then I'm going to sell equity out of this pocket to this other group, right? It's just a guaranteed way to create conflicts and to create big fights between these different groups, right? So it's sort of like, that's problematic, right? So
It's not just that. It's also other investors who have, you know, a history of dumping tokens as soon as they can, right? Like we have
That's
never
right.
sold a token. We just haven't, because we think, you know, if the company is worth what we think it will be worth in 10 years, I want to still own those tokens. But others have a much more short-term view, and that's a big problem, right? And you kind of have to police who gets in the round, who doesn't.
Yeah. So I wanna back up what you're saying, and like, founders should diligence who's on their cap table. I think one of the worst sins of the bull market is people would be like, party round, term sheets Friday, in or out, and it's like, you don't know us and we don't know you. So like, the fact that you're offering space on your cap table to us without having any clue who we are is very, very disqualifying about you. Like, you are the one who's not understanding that you're going into business with people. And, you know, I think it's just a wrong mindset.
That's great advice, but I will say, my guess is the major problem they're having is not picking the wrong money.
But look, but there's also very specific uses for some security tokens. Like you can tokenize a building, and that is...
No, I assume that he was talking about utility tokens.
You're talking about utility tokens, right?
Utility token, that's a native token within the company.
Sure. So I think we're all, well, I'm certainly here, you know, as a VC, I'm trying to make money, so I'll invest in anything that I can make money. And the nice thing about equity is you can actually run models and come up with I used to be a securities analyst on Wall Street, so, you know, that's what I did, you know, come up with models to value stuff. The problem with utility tokens is can't really do that today, at least. And so it's really just a popularity contest. Is this going to be more popular or not? I think over time we will get valuation metrics around utility tokens. You know, it's my belief at the end of the day that the value really comes from the community, and that we'll kind of get community-based metrics that will drive valuation of utility tokens, but we're not quite there yet.
Right, but you can look at utility tokens and the value and you know, staking and things like that. So there is ways to...
Well, there's no value in staking. Also, no offense to staking companies, but, you know, I mean, all staking is taking money away from the people who don't stake and give it to the many people who do. So it's not creating any value.
Well, no, but you're getting the staking. You're getting the staking, the pay in kind staking from the association. You're not getting it from your co-investors. So I would disagree with that.
I always struggle with these conversations because the word staking generally, I would say, applies to proof of stake networks, and I think we should use a new term to called promises not to sell, which is the majority of what people call staking, right? So I think there's a distinction.
I'd vote for that.
Right? Which is if you're
if
you're helping to secure a network with staking as a staking mechanism, proof of stake, that's actual staking. The rest of it is just promises not to sell, and maybe binding promises.
Yeah, I agree.
Smart contracts that force you not to sell.
Do we have another question from the audience?
I mean, I think the reason why, while the mic's traveling, I think the reason why that distinction's pretty important is that 90% of what people call staking is a fundamentally different mechanic, and people need to understand it. And what Lou said is perfect, which is it's a mechanic that doesn't actually accrete value, whereas staking does because it secures the network. So
well, I mean, I will say it does. I mean, there is value to the company of knowing that more of their tokens are tied up.
Yeah. The promise is not to sell, but that's different.
So Lou, you said winter is always coming, right? And
Unless
I
it's
agree
here.
with that, right? So winter is always coming. So I'm curious about why people aren't better prepared. I know Mike has talked about the brain.
Have you not met people?
Right. So that's the issue. We're human. So do you have any, does anybody on the panel have like favorite tips to alert that the bear is coming? Or what have you seen, maybe, Mike, in the development of the brain and the cortex? What's the issue here?
Yeah, I mean, we're always trapped with this like evolutionary legacy history of like 3.7 billion years of nervous system evolution. So like, I think one of the great things that people do is they worry, right? So like worrying is actually a great thing, right? Especially in a wintry condition, right? So I definitely recommend that everybody worry all the time.
I mean, I think we talked about it in the beginning, where it's still, as a founder, being frugal and always kind of being ready for that next winter to come. So always like spending money very frugally, saving money when you can. So I just think that's something for most founders to be cognizant of.
I mean, I think that as, someone who's sat on, called 100 boards over my career, I will sit there with another VC, and the other VC is telling the founders to spend money as fast as possible. Going back to the thing I said before, grow at any cost. And I'm sitting there going, no. And they're saying, no, we can go get you more money. Go spend the money as quickly as possible. Grow at any cost. Don't worry about making money. Don't worry about cash flow. Spend.
Yeah, I mean, the weird thing is, right, if it's like playing craps, right? And if it's their first time at the craps table, right, and all they've seen is everything's building, somebody's on this awesome roll, right? The smartest person is a guy who's left it all out on the table and keeps on pushing it out and pushing it out and pushing it out, and he's the smartest guy, until he's not.
Until it goes wrong.
Yeah, I mean, every bubble ends with a crash. That's what it does. Capitalism, it turns out, unregulated, gets us massive swings between bubbles and crashes, because that's humanity, and it's government's job to tamp that down. That's what the Fed's supposed to do, but I'm not quite sure how good they are at it.
But if you get big enough, then the government will bail you out.
Yes, that's right. Good point.
Do we have any other questions over there?
But the truth is, it's balanced, and it's hard, right? It's hard, but again, I think most entrepreneurs, err on spending too much and not cutting fast enough. It's hard to cut.
Gotta spend it like it's your money, not like your investor's money, like literally yours, and hold on to it and make it last as long as you can.
Sometimes you gotta make Sophie's choice.
So in a down market in particular, you always hear people say build, build, build. It's kind of weird because normally NFTs pick up right before another crypto winter happens. That's what happened last time too. But a bigger problem with like applications and users coming onto it is once you get adoption, the blockchains right now, none of them could scale. So whether it's RPC nodes or indexers, if you're building a dApp, right now the blockchain is a one-way system. You can only write to it. You have to index the whole entire thing to build an app to read from it. It's too slow to go back and forth. That requires a Web 2 solution to use it. So when you're looking at investment and ideology and you're talking about promoting and saying to go build, what should they build?
So I think I want to directly kind of grapple with the indexing problem, right? Which is that tooling, right? There's actually really awesome developer tools for dealing with indices, right? So like you can definitely like grab one and just run with that. So I would say with respect to kind of like the infrastructure isn't there. Like it's there. I think we can build applications now.
Wait, the indexer part though, you have to wait for block finality, which can take an hour to 1 minute to seconds or whatever. Then you can index it. Then you can pull it in. Then you have to read the block, unless you're going to read the metadata and the JSON data on the outside, which inherently is a shortcut and is not ideal because then you can't build an app that actually does what it's supposed to do. So if you're trying to build an application, that's like trying to build a real-time app with a dial-up connection.
No, it's fine. It's fine. The reason why I assure you that it's fine is that, like, blockchain is applicable for finality, and, like, what you want to do is build an application that users enjoy and they want to use, right? That will require effectively eventual finality, right? So if you require fast finality, then stick with centralization.
I respectfully kind of disagree with that, just because we built an app that allows someone to create an NFT in 6 seconds. Millions of people came on to do it. The cost and spend is so high. People want to embrace Web3. They want the privacy of it, but the application aspect of it doesn't allow for it.
Yeah. I'm not saying that there aren't certain applications that you shouldn't try to build. I'm not saying all applications are buildable. I'm saying there are applications that are buildable today.
I can't answer. I don't understand this tech stuff. But we have 3 seconds left. So why don't you finish up?
All right, yeah. Why don't you guys, first of all, thank you so much for your time. Why don't you just let the audience know where you can be reached other than tackled when you leave stage? And then maybe just wrap it up.
Anybody that wants to get in touch with me, you can talk to Teddy Stouffer. He's in the back. He does all the real work.
Yeah, Twitter probably is best. I'm under Trading Female, or my email just alana@redbeard.ventures.
So all my socials are on miko.com, miko.com. You can also email me at the bottom of the page, so it's easy.
Yeah, and I'm Lou Kerner everywhere, Twitter, Gmail, LinkedIn. Thanks.
There is also a cool new feature on our events platform that I think is not very well known yet, but anyone with a ticket can send messages to speakers when you go to their profiles. Hint, hint.
Yeah, my profile is on their website.
All right. Thanks, everybody. Thank you, guys.
Thanks,
Thank
buddy.
you.
Thanks.